Welcome back to Money Mastery Now, the channel that helps you take control of your money, one smart habit at a time. If you want to master your budget, crush debt, and build lasting wealth, you're in the right place. Let's dive in. Have you ever applied for a credit card, tried to rent an apartment, or wanted to buy a car only to be told that your credit score wasn't high enough? Maybe it caught you by surprise. Maybe no one ever explained what a credit score really is or how it works. Maybe it felt like some mysterious number that just appears, controls everything, and no one really tells you why. Well, today, we're going to change that. Whether you've been living in the US your whole life or you're just starting your financial journey here, understanding your credit score is one of the most important things you can do for your money. Why? Because this one number doesn't just sit in a file somewhere. It follows you, it grows with you, and it can open or close doors in your financial life. Your credit score can determine the interest rate on your next loan. It can affect whether you're approved for a credit card. It might even impact whether you get approved for an apartment, or whether you have to pay a security deposit on utilities. In some cases, employers may even check your credit history as part of a job screening process. But don't worry, this video is not going to overwhelm you with technical jargon. My goal is to break down what a credit score actually is, how it's calculated, how it affects your finances, and most importantly, what you can do about it. By the end of this video, you'll not only understand your credit score better, but you'll also know exactly how to improve it, protect it, and use it to your advantage. So if you've ever wondered what this three-digit number really means, you're in the right place. Let's get started. Let's start with the basics. What exactly is a credit score? A credit score is a three-digit number that represents your creditworthiness. In simple terms, it's a number that tells lenders how likely you are to repay money you borrow. Think of it as your financial reputation. In the United States, the most commonly used credit scores range from 300 to 850. The higher your score, the better. A high score means you're considered low risk to lenders. A lower score, that suggests you may have had trouble with payments or credit management in the past. But this score isn't pulled out of thin air. It's based on the information in your credit report, a detailed history of your financial behavior that's collected by credit bureaus. There are three major credit bureaus in the U.S. Experian, Equifax, and TransUnion. These agencies collect data on your loans, credit cards, payment history, and even the number of times someone has checked your credit. Then, companies like FICO and VantageScore take that data and calculate your credit score using their own formulas. You might have heard of a FICO score. That's the most widely used scoring system, especially by mortgage lenders. VantageScore is another model that works similarly and is often used by free credit monitoring services. Now, you might be wondering, do I have just one credit score? Not exactly. You can actually have several scores at once. Different lenders might use different versions of FICO or VantageScore, and each credit bureau might report slightly different data. That's why your score can vary a little depending on where you check it. But don't worry, you don't need to memorize every version or keep track of every slight change. What matters most is understanding the overall range your score falls into and knowing what influences it. And that's exactly what we'll talk about next. What goes into calculating your credit score and how each factor impacts your number. Let's break it down. Now that we know what a credit score is, let's look at how it's actually calculated. While there are different models out there, the most commonly used, especially by lenders, is the FICO score. This score is built from 5 key factors, each carrying a different weight. Understanding these can help you know exactly what to work on if you want to improve your score. Let's go through them one by one. First and most important, payment history. This makes up 35% of your FICO score. It looks at whether you've paid your bills on time, credit cards, loans, mortgages, and even some utility bills if they've been reported. A missed or late payment can hurt your score, especially if it's recent or hasn't been resolved. If you do just one thing to protect your credit, make it this. Always pay at least the minimum due, on time. Even one late payment can stay on your report for up to 7 years. Second, amounts owed. This accounts for 30% of your score. It's also called your credit utilization ratio, which is a fancy way of saying how much of your available credit are you using. For example, if you have a credit card with a $5,000 limit and you're carrying a balance of $4,000, that's 80% utilization, way too high. Ideally, you should aim to keep this ratio below 30%, and even better, below 10%. Why? Because using too much of your available credit can signal to lenders that you're stretched thin or overly reliant on credit. Third, length of credit history. This makes up 15%. The longer you've had credit accounts open and the longer you've been using them responsibly, the better. This includes your oldest account, the average age of all your accounts, and how long it's been since you last used them. Here's something many people don't realize. Closing old credit cards, especially your oldest one, can actually lower your score because it shortens your credit history. Fourth, credit mix. This is 10% of your score. It refers to the variety of credit types you have: credit cards, auto loans, student loans, mortgages, and so on. Having different types of credit can be a good sign to lenders, as long as you manage them responsibly, but don't go out and open a bunch of loans just to boost this factor. It's a small part of your score and should grow naturally over time. Fifth and final, new credit inquiries. This also makes up 10%. Every time you apply for a loan or a credit card, it creates a hard inquiry on your credit report. Too many of these in a short period can lower your score, because it might suggest that you're taking on too much debt too quickly. A good rule of thumb: don't apply for multiple credit cards or loans all at once. Space out your applications, and only apply when you actually need the credit. Now let's recap. Payment history, 35%. Amounts owed, 30%. Length of credit history, 15%. Credit mix, 10%. New credit inquiries, 15%. Together, these 5 factors form the foundation of your credit score. And the good news, most of them are entirely within your control. In the next part, we'll break down what your actual number means, how to interpret your score, and what lenders see when they look at it. Let's keep going. So now that we understand how your credit score is calculated, let's talk about what those numbers actually mean. In most scoring systems, especially the FICO score, your number will fall somewhere between 300 and 850. The higher the score, the better. But what do those numbers really say about you to a lender? Let's break it down. A score between 800 and 850 is considered excellent. People in this range have a long history of on-time payments, low credit utilization, and strong credit habits. If your score is in this range, you'll typically qualify for the best interest rates, lowest fees, and most favorable loan terms. Lenders see you as extremely low risk. 740 to 799 is very good. This is still a strong range. You'll likely be approved for most credit cards and loans, and you'll get pretty competitive rates. Lenders see you as a reliable borrower. 670 to 739 is good. This is the national average. With a score in this range, you can still get approved for loans and credit, but your interest rates may not be the lowest available. You might also face stricter requirements when applying for larger amounts. 580 to 669 is fair. This score tells lenders that you may have had some issues in the past, maybe late payments, high balances, or collections. You can still get credit, but it might come with higher interest rates, lower limits, or the need for a cosigner or a larger deposit. And finally, 300 to 579 is considered poor. At this level, getting approved for credit becomes more difficult. If you are approved, you're likely to face the highest interest rates, lower limits, and extra fees. Some landlords, utility companies, or even employers may hesitate to work with you based on this score. Now, These categories aren't set in stone. They're guidelines used by most lenders, but some companies may have slightly different definitions based on their own policies. Let's take a real-world example to see how credit score impacts your finances. Imagine two people are applying for an auto loan. One has a credit score of 780. The other has a score of 610. They both want to borrow $2,000 over 5 years. The person with the 780 score might qualify for an interest rate around 4%, while the person with the 610 score might get a rate closer to 12%. That difference in interest could cost the second person thousands of dollars more over the life of the loan just because of credit score. And that's not just for loans. Your credit score can also affect whether you need a security deposit when renting an apartment or opening a utility account, whether you qualify for zero-interest credit card offers, whether you can refinance your home at a lower rate. This three-digit number carries real financial consequences. It's not just about borrowing money, it's about your everyday cost of living. The good news is, even if your score isn't where you want it to be, it's never too late to improve it. In the next section, we'll explore the specific ways you can boost your credit score, starting with actions you can take today. Let's dive in. By now, you might be wondering, why does this one number matter so much? The truth is, your credit score affects more areas of your financial life than you probably realize. It's not just about borrowing money. It's about access, trust, and cost. Let's start with the obvious one: loans. Whether you're applying for a car loan, a personal loan, or a mortgage, your credit score helps the lender decide two things: whether to approve you and what interest rate to offer. A higher score usually means a lower rate, and over time, that can save you hundreds or even thousands of dollars. Next, let's talk about credit cards. Your score affects your ability to get approved for new cards, qualify for balance transfers, or earn rewards like cashback and travel points. Better scores can also unlock higher credit limits, which gives you more flexibility and helps your credit utilization. But it doesn't stop there. Many landlords check your credit when you apply to rent an apartment. They use it as a way to measure whether you're likely to pay rent on time. A low credit score doesn't guarantee rejection, but it may mean you'll need a cosigner or pay a higher security deposit. Utility companies like electricity, water, or internet providers sometimes run credit checks before starting service. If your score is low, you might be required to pay a deposit up front. Even car insurance companies in many states look at your credit score when calculating your premium. And yes, a lower score can mean a higher monthly bill even if your driving record is clean. And here's something that surprises a lot of people. Some employers check credit reports, not scores. But the reports when hiring for roles that involve money, security, or sensitive information, a history of missed payments or high debt might not disqualify you, but it could raise questions about reliability or risk. So when we talk about credit score, we're not just talking about a number in a file. We're talking about real-world consequences that affect your day-to-day life. It can influence where you live, what you drive, how much you pay for basic services, and even which job opportunities you're considered for. That's why managing your credit score isn't just about building a better future, it's about protecting your options today. The good news is, your credit score isn't fixed. You have the power to change it. And in the next part, we'll go through the practical steps you can take to improve your credit score starting right now. Let's continue. If your credit score isn't where you want it to be, don't worry. The good news is that it's not permanent. You can improve your score over time, and in some cases, you might start seeing progress within just a few months. Let's walk through the most effective ways to boost your credit score. First, make your payments on time. This is the single most important thing you can do. Remember, payment history makes up 35% of your score, whether it's a credit card, a car loan, or a student loan. Always pay at least the minimum amount due on or before the due date. Set reminders. Use auto pay. Do whatever it takes to avoid missed or late payments. Second, lower your credit utilization. This refers to how much of your available credit you're using. Ideally, you want to keep your usage below 30%. If you're using more than that, try to pay down your balances. Another trick is to ask for a credit limit increase if you can manage it responsibly. More available credit with the same balance means a lower utilization ratio, which helps your score. Third, don't close your oldest credit accounts unless you absolutely have to. The length of your credit history matters. If you've had a card open for 10 years and it has no annual fee, consider keeping it open, even if you don't use it often. That long history is working in your favor. Fourth, only apply for new credit when necessary. Every time you apply for a new card or loan, a hard inquiry is added to your credit report. Too many of these in a short time can hurt your score, so space out your applications and be intentional. Fifth, check your credit reports for errors. You're entitled to one free report per year from each of the 3 major credit bureaus: Experian, TransUnion, and Equifax. Go to Annual Credit Report. And download yours. Look for mistakes like accounts you didn't open, incorrect balances, or payments marked as late when you paid on time. If you see something wrong, file a dispute. Fixing an error can make a big difference. Sixth, if you have limited credit history or a low score, consider using tools to help build credit. For example, you can apply for a secured credit card, where you put down a deposit and use the card just like a regular one. Some banks and apps also offer credit builder loans that report your on-time payments to the credit bureaus. Also, newer tools like Experian Boost allow you to add on-time payments for utilities and streaming services to your credit file. These aren't traditional credit items, but adding them can give your score a little push, especially if your history is thin. Seventh, be patient and consistent. Improving your score is not something that happens overnight, but every on-time payment, every reduced balance, and every smart financial decision adds up. It's about building habits and momentum. Here's a quick summary of the steps. Pay on time, every time. Keep your credit usage low. Maintain your oldest accounts. Limit new credit applications. Check your credit report for mistakes. Use tools to build positive credit history. Stay consistent and give it time. Improving your credit score is like building trust. It takes effort, but once it's there, it opens doors and it gives you peace of mind. In the final section of this video, we'll wrap up everything you've learned, and I'll share a few closing thoughts to keep you motivated on your credit journey. Let's finish strong. We've covered a lot in this video, so let's take a moment to step back and look at the bigger picture. Your credit score is not just a number, it's a reflection of your financial habits and a key that unlocks opportunities. Whether you're applying for a loan, renting an apartment, or planning for your future, your credit score can either open doors or create obstacles. The good news: it's never too early or too late to take control of it. You've learned what a credit score is, how it's calculated, what the different score ranges mean, and how it affects your financial life. More importantly, you now know what steps you can take to improve it. Practical, doable actions you can start today. Building or repairing credit doesn't happen overnight, but every small step counts. Every on-time payment, every reduced balance, every smart decision gets you closer to the financial freedom and stability you deserve. So if your score isn't where you want it to be, don't get discouraged. Get focused. Start small. Stay consistent. And give yourself time. If this video helped you understand credit scores better, consider sharing it with a friend or family member, because credit education is something we all need, but few of us were ever taught. And if you're ready for the next step, check out our next video on how to build a strong credit history from scratch, especially helpful if you're new to credit or starting over. Thanks for spending your time with me today. You're already ahead of the game just by being here and learning. Take what you've learned, apply it, and keep moving forward. You've got this.